Hello everyone. Wanted to take just a couple minutes to explain what is happening in the market right now, especially with the banking system. So a little bit of background, and then we're going to explain how this all affects what's happening in the bond market and what's going to happen with our rates. So let's start first with the banking system. The banking system works with people putting deposits into the bank. The bank holds a percentage of them. It's not necessarily 10%, but a certain amount that they have to keep there depending on what their assets are. The remaining, that's what they use to invest and try and make money with. They have to pay back a little bit of interest to the people that put the deposit in, and then the rest of it, they're making maybe a better yield difference, maybe 2%, 3%, and then that's what they end up netting. So you multiply that by multiple clients, and that's how they make money by doing this. Now, with the Feds, they have been raising their rates, and for a while we've been talking about that. And the problem is that they've been raising them so fast. They needed to a certain extent because we needed that, but it's like giving medicine and then it's not working 5 minutes, so we give more medicine. It's not working, and pretty soon we've overdosed. And this is kind of what's happened in our market now. So to begin with, when they're doing this, that the banks, because of the shrink in the net interest margin, that's making it a little bit harder for them to get a little bit of a net on there. But the bigger problems are two things that are happening. The first is that there's a way better place for depositors to get a better yield. They could go to the 10-year treasury and get 4 or 5%. That is a way better return of investment than it would be if you just take your money to the bank. So people are withdrawing money from the bank and they're buying treasuries with it because you make more money. So it's draining the banks, and that's slowing down the economy there. The other problem, though, is that there's less deposits available, so they have less money there. So that's what sort of started the problem with this. Now, they got Silicon Valley Bank got on the radar, and savvy investors sort of looked at it and they saw the cracks in there. They were seeing a mismatch, and there was actually, because of some of the Dodd-Frank things in 2008, there's kind of hidden losses that they don't have to really show on there. But if you look in there, you can see that they were actually losses of $15 billion. Investors started seeing this. They were advised to pull their money. And there was sort of a run on the bank, and it forced them to sell around $21 billion of their assets with a realizing of $2 billion loss. Investors see this. They can also see there's another $15 billion of unrealized loss with the remaining $60 billion there. And so it's basically saying that this bank is insolvent, and that's what the crisis is. This leads to more trouble. The people can smell the blood. Everyone's starting to pull back out. Now, this is the problem. It caused a run on the bank, and because they only keep a certain amount of there, like that 10% or whatever that amount is, there's not enough money back for the depositors. So that makes other banks under scrutiny, and it just starts to spiral. At the beginning, the Fed's reaction was we're not bailing them out. That was their first reaction, which was very scary. But now they're coming back and saying, okay, we're going to protect those that are depositing their money there, and we're going to keep this at face value. So it's kind of a quasi bailout. Okay, so that's a little bit of background with it. How does this affect us? So being in the bond market is a flight to safety. Whenever there's things like this, a safer place to put your money is the bond market. So we'll show the bond market later, but basically more interest in the bond market means that there's more buying there. That means rates go down. I think it's going to rethink the reckless policy of the Feds. They're starting to realize some of their actions are going to have some really bad ramifications that are going to cost a lot in our economy. So I think that's going to help there. There might be another version of a quantitative easing, even in the other central banks that they're looking at that. The importance of the inverted yield curve, I'm going to go back to the yield curve in just a second, and deflammation, which is the opposite of inflation. It's the opposite of it. So prices are going to start to decrease. So there's a lot of positive things here. Prices might go down, rates might go better. There's always the boomerang. There's always the kind of repercussions with things. But overall, this might be a positive thing. So going back to the Treasury yield curve, I've talked about this before in the past, but whenever there is a yield curve, it's kind of showing you that there's something going wrong in the economy. So you can see what happened in the 80s, a little bit, those times. Look what happened with this big crash of the housing market. It was just barely inverted. And look where we are right now. There's a big inversion happen here. This is telling us that we're going into recession. That's why deflation is probably going to happen, those type of things. So going to the bond market, here we are. We can see, and this is looking at the 10-year treasury, we were above 4%. And we got all the way down to 3.44 today. That is a big, big dive in the last little while with the 10-year treasury. Now, we raised, it got up a little bit. We're now at 12 basis points today, which is still pretty big, but it went down a little bit further. This is telling you this big changes here, that there's a lot of volatility still happening. There's a lot of investors that don't know what to do with their money. So let's look at, I want to show you the bond market as well too, because the same thing is happening there. It started out and we had over 100 basis points change today, but then it kind of went back down again. So we were all the way up here at this point and then it went back down. So we're a little bit here again. On Friday, we were all the way up here and we went back down again. So we are making progress, but if we look at this compared to February the 2nd, there's still some room to go even to where we were in January. And if I bring this out a ways so you can see what's really happening the long term here, you can see that we're still a long ways away where we were before, but we are going the right direction. I think if this continues, this might be the beginning of the end of these rate hikes of the government. We will see some improvement in our rates. And like I've said before, I think we're still, some rates are even in the 7s still, but I'm starting to think that we're going to be back in the 6s. Just kind of depends on your loan level pricing and what kind of loan you're getting. But it does look like we're going the right direction. I think we are going to be back in a little bit better rates. But this is something to look at, and we're going to keep looking at it. And like I always do, I follow the market very carefully, and we'll keep giving you updates. Hope this is helpful.